Hi, today we'll start a very important topic, financial information. So in this small video, I'm going to introduce some basic topics, particularly business finances and the cash flow. So the learning outcomes of today's lecture would be, by the end, you need to be able to explain why businesses, they need finances, distinguish between short-term and the long-term financing, different sources of finance available to businesses, internal and external sources of financing. Okay, so the first question would be what these guys do, what the finance department does. So the first thing would be that they're in charge of recording all financial transactions, payments, and sales revenue. So these guys they're keeping track of all these financial transactions that take place within the company. And then they do prepare the final account. We'll talk about that income statement, as well as it's also known as profit and loss statement. They produce some accounting information for the top managers to make better and accurate decisions, as well as forecasting the cash flow. Forecasting the cash flow is quite important to anticipate the future losses as well as gains, and to make appropriate decisions whether to invest or not, whether to expand or not, and whatsoever. Okay, now let's begin with some expenditures. Now, we do divide the expenditures into two broad groups. The first one is called capital expenditure. We've already started discussing the capital expenditure. So the capital expenditure is usually money spent on fixed assets. It's usually a huge amount of money that you do not spend regularly. You do it sometimes or quite seldom. Okay, so this is not something that you want to do regularly. So by saying fixed assets, it may mean it's going to be a land, it's going to be a big equipment, or some other assets that actually cost a lot of money. Whereas the revenue expenditure, it's a daily basis, it's a day-to-day expenditures that your businesses will incur. It can be the wages, it can be salaries, it can be some other costs that your business will do regularly, will have regularly on monthly basis or yearly basis. Okay, now what are the financial needs of a business? Let's take a look at them. Now, we've already talked about revenue expenditure and the capital expenditure. So there are two types of them, as we said before. And also, when you only start up a business, then you will need some startup capital. Now, the source of startup capital can be various. So the first one can be your own money. So if you are, for example, a group of people, of 2 or 3 people, or just even one person, you're going to use your own funding, your own sources of money, your savings to start up your business. And by the way, there is a question in a business plan: what is going to be your startup capital and how do you calculate it? And you need to be able to justify your business's startup capitals. Okay. Capital to expand the business as well. So if you're considering organic growth, for example, then you may actually want to take and think about some sources of funding to grow. So, for example, opening another sales point in another city, another geography, or any other expenditures that you may need to expand your business. Additional working capital. Okay, we'll talk about working capital in the next slides, I guess, in the next lectures. So let's just restrict this one here. Okay. Now, okay, guys, so this is the starting point. It might kind of be non-coherent, but this is just a startup to warm up you, so to get acquainted with some basic concepts and basic terms. So that's why we're going to jump from one place to another one. So apologies for that, but you just need this finance language so that we can use these finance languages in the further topics. Okay. Now, sources of finances, it can be internal or external. So if we think about internal sources of financing, then the good news is that this is your business money, so you don't have to borrow it from someone, and therefore you don't have to pay interest. And we all know that when somebody gives you and borrows money, then obviously the company will need some, the bank, for example, or some other finance organization will need some interest extra paid on top of that borrowed amount of money. Reinvesting the profit into the business. So the internal source of where do you get the money from, right? Now, your business may actually have some retained profit. We're going to talk about this term, retained profit. So this is actually the amount of money that your business can actually not spend. It retains within the company. It's a surplus of extra money that a company has previously generated, and the one that you can actually use in financing your objectives. Okay. You can also sell assets. So one of the ways to find some internal financing without actually borrowing from somebody, you can actually sell your own assets, your own assets. So it can be, for example, office, it can be land, it can be equipment, it can be some other assets, some physical, tangible assets that you may actually worth considering to sell if you don't need them right now, and which will generate some money. Okay. Now, so we've discussed it a little bit already. So we've highlighted that internal source of financing can be one, retained profit. So this is the profit that your company has generated. It has paid all the debts. It has paid all the liabilities. Okay, liabilities, обязательства. And it even paid dividends. Okay, it paid taxes. It paid all the costs incurred this month, and then it has some retained profit that wasn't divided yet. So the retained profit is a very good source of financing to meet your new objectives. And then the sale of surplus assets, it can also be another one that we've already mentioned. If you do remember inventories, selling inventories, if you don't need them right now, or you think it's just too much, and by the way, this is the waste. Selling the surplus of inventory can generate some extra money. Okay, let's talk about external sources of financing. So let's say that you do need some finances, you do have some money in your company, you maybe sold something out, or you maybe sold some inventories, but you still need some extra money. Then in this case, you may want to refer to external sources of financing. And the first one, the very conventional one, is a bank loan. Now, the bank loan, obviously, you will have to pay some extra money, which is called interest. So depending on the interest, the amount of extra money that you'll be overpaying would vary, and depending on the number of years you borrow. Now, microfinance, the difference between bank loan and the microfinance, obviously, microfinance interest rate is usually much higher than the banks. The reason why microfinance organizations exists and why people and even some firms, they do rely on microfinancing is just because bank loans are not available for them. So sometimes banks, they do reject these companies because of maybe a bad history or any other reasons. So in this case, microfinances, which are a bit riskier organizations, they actually may borrow you some money, may lend you some money, but they do have the risk, because if the conventional bank didn't give you the money, that means that you're a risky customer for them. So that means that the higher the risk, if you do remember, the higher the reward should be. So this is the law of finances. This is the law of the business. Now that's why it makes sense for microfinance organizations to charge more, because you are a bit riskier client for them. Now, sell depth to depth factor is a little bit specific. It's a little bit specific. It's usually true for finance organizations such as banks, for example, where they actually sell the debts into other finance organizations. Okay. Well, I don't want to talk about this a lot more, because this is a very specific one. Now, a very conventional one, if you are a public limited company, you may want to consider selling the shares. And obviously, if there are some grants and subsidies available, it can also be a very good external source of finances. Now, the debentures is a very specific one. You may have heard about some bonds like government bonds, obligacji. Now, these bonds are not only issued by governments, they can also be issued by the companies. And the debentures is a specific term where the bonds, this is the financial tool of borrowing, where they actually lend some money from people. And this is particularly called debentures. So this is companies' bonds that are issued by the company and which are secured by the assets. Okay, now in this particular case, the microfinance organization actually provides some loan to starting a small micro business entrepreneur. Okay, now the first question, if you can read this one first at your own time, and then the first question is, why do you think the traditional banks wouldn't lend Praveen money for her business? As we already told you before, the traditional banks may not actually lend some money because of not proven history before, or not having any assets that may actually secure. So if you do remember, banks can actually give you a lot of money. They can borrow a lot of money only if you can actually secure, we call it collateral, zalog, this borrowed money. So that means that the bank will be assured that if you fail to give back the money that you borrowed from them, they will actually take that particular asset away from you and sell it, and that the deal actually will be higher than the original money that you borrowed. So that's what traditional banks do. If you do not have such an asset, then microfinance organizations may actually be a key. Okay, now explain the benefits. Well, a small loan has enabled her to start her business eventually and earn some money. But again, it's a bit risky because if she eventually fails, then this organization, the microfinance organization, will charge a lot of fees, a lot of fines, I would suggest, and therefore she'll be in trouble. Okay, now we also divide up the finances into two categories, like short-term and the long-term. In finance, the distinction between the short-term and the long-term is actually 1 year. So everything that is below or until 1 year is considered to be a short-term, and everything that is beyond 1 year is going to be considered as a long-term. Now, the short-term can be overdrafts from banks. Now, what's the difference between loans and overdrafts? The loan is a long-term borrowing. Okay, so if you're borrowing from the bank for more than 1 year period, it's going to be called loan. If it's less than 1 year, it's going to be called overdraft. That's it. Sale of shares, again, we already told you that what is selling of shares. You can issue the new ones. Yeah, so basically, I would like to talk about only these 2 or 3. So overdraft, the bank loan, maybe also about leasing. Okay, now what is leasing? Leasing is when you, it's like a rent, but it's not rent because ultimately, at the end of the leasing, you actually do have a right to have it, to own it, as well as you do have a flexibility to give it away until some period of time. So leasing is a very flexible instrument where you actually do use some equipment. For example, in agriculture business in Kazakhstan, we do have these big machineries, right? So the businessmen, they actually do have a choice. They can actually spend a lot of money and buy these machineries, which are a bit costly, and eventually a lot of times they just do not have their own sources of money, so they either have to borrow money from the bank as a bank loan and then buy them, which is not a very good news because you have to overpay such a a lot of amount of money. That's why the leasing instrument can be a very good option. So the companies that do produce these machineries, they actually have a deal with these agriculture businessmen saying that, okay, you can have this machinery at a leasing. So they're gonna sign up the contract, the agreement, that after every single month you're gonna pay some certain amount of money. Okay, so by the end of the contract you can actually own this particular machinery. And even if you change your mind before this particular period of time, before it expires, you can actually change your mind and say, well, thank you for providing me this one, I no longer want it, as well as you can actually pay until agreed certain amount of period of time and then own the machinery, which is very good. When you rent it, you can never own this particular machinery. You'll just pay and never have it. Okay, you will never own it. Whereas in leasing, it's quite flexible. Okay, I'm gonna talk about gearing and then finish this particular short video. Now, what is gearing? Gearing is it's a proportion. It's a measure of risk. So when you borrow the money, your entity, your enterprise becomes a risky. For whom? For external borrowers, for investors, for other banks. Now, if your company in their capital structure has a lot of debt, then that means that the gearing ratio is very high. That means you're not a very good company to invest in because you do have a lot of debt. And now if things go wrong, for example, nowadays we do have a pandemic and lots of businesses, they do struggle to pay their liabilities, обязательства, liabilities. Then in this case, you may not actually generate the forecasted revenues and the forecasted cash flows, and in that way you might be in trouble. And therefore the investors actually do have a risk of not being able to return the money invested because guess who is paid first when the company has problems, when company has financial problems? The first who is going to be paid are employees, then banks, and then after all the payments to your contractors, to your suppliers, only then the investors might be able to get something if there is something left over. So investors are actually having a lot of risk when they do invest in those companies that have a lot of debt already. So the gearing ratio is a measure of risk, of how much debt you have in your capital structure. Good. Now, again, this is the last one: banks versus shareholders. Banks, they do make a decision whether to lend or not based on some criterion. So is there a cash flow forecast available? So they actually do look at your forecast cash flow. They do look at your business plan, by the way, that you're currently doing. So it's worthy still, okay? If you do run your business in future and decide to go to the bank to borrow some money, the business plan is still a very useful instrument. Now, is forecasted income statement available? Again, so we're going to distinguish between cash flow and the income statement. Okay, we'll look at these different statements. They will also look at, is it secure? Do you remember secured or collateral? If you're borrowing $1 million of cash, then they will obviously, the banks will say, okay, you're borrowing such a lot of money, you're a good company, but we want to guarantee that if things will go wrong, we can have your asset, sell it on the market, and at least return our $1 million of money. Okay, and they are also look at the gearing ratio. If you have a lot of debt already, then banks might be very reluctant to give you additional money. Now, shareholders, they do look at the future prospects. What is the company's objectives? Who are the people who are running the company? They will also look at the share price varied. So if we are talking about public limited companies where the shares are sold and bought on the market every day, they will actually look at the trajectory. They will look at how company has been doing historically. Are they actually paying any dividends if it's a public limited company? And again, what's the gearing ratio? Okay,